Welcome, welcome, welcome. This is going to be a new style of a lecture where I want to get a little bit more heavy into the world of systematic trading, my favorite way to trade. Historically, if you've watched all these lectures, you know we've done advanced options strategies to get everyone on the same, level playing field there. Just obviously, I like the advanced ones better because I think you actually have a better edge in the market. Then from there, we went into some more of the backbone of, in my opinion, successful trading, pure statistics of what is right, what is wrong, how to interpret it, knowing if you're truly trading with an edge. So obviously, the first thing we did was apply those statistics to advanced option strategies. Now, just for I suppose a breath of fresh air, I'm interested in doing that same type of overall mantra, but applying it to the futures market. So the name of the game here is me, DJ and Matt, with all of you, will be explaining what in the world futures trading is. And then from there, I actually want to do live examples with all of you of actually directly applying systematic trading, as in a robot is deciding when to buy and when to sell. I kind of want to go over the creation of said robots for the futures market. Obviously, this would be applicable to other markets such as crypto and equities, but I think there's actually various advantages to futures trading, especially when you look at it through the lens of systematic trading, that I like it the best. So I want to be sharing that with you today. Now, if you look on the interwebs, the Googles, if you will, futures, derivative financial contracts that obligate parties to buy or sell an asset at a predetermined future date and price. Now, obviously, if you read that, you're first of all going to be like, well, that's borderline legalese that I don't understand anyway. And then if you think about it a little bit more, you're going to be like, well, that sounds a lot like options of people buying contracts, buying and selling. There's expiration dates, that type of stuff. And you're partly right to think that. There are overlaps. There is this concept of the contracts ending at a certain date. There is a concept of you paying for a value of a contract that isn't the exact same financial value as the underlying. So it is a derivative product, as in it's built on top of some underlying asset. But there's also quite a few differences. Now, before we get into like how futures actually work, I first want to get of the pros and cons of like why you should even be listening to this anyway. The first thing that's going to jump out to you is no pattern day trading. If you are trading equities, if you're trading options, and your account in the US is below $25,000, you are only allowed 3 opening and closing trades on that same calendar day. You're only allowed 3 of those every rolling 5 days. I don't get why. In the US, they say everything's equal, but yet if you have below 25K in a margin account, you're not allowed to do that. That does not exist in futures. In futures, if you have a $1,000 account, you can buy and sell till your face turns blue. You can trade as much as you want. It will not matter. Another advantage relative to option is there's no time issue. Your back isn't against the wall with time, aka there's no theta decay. So options, yes, it's a derivative. There's an underlying product. Let's just through this, we're going to use a lot of the S&P 500 as an example. You could trade SPY calls or puts. You could trade SPX calls or puts. And if you're long calls, long puts, yes, you're hoping it volatility goes in your favor because of time. You want the most time possible because time's working against you. Obviously, that doesn't exist if you just buy SPY. If you just buy SPX, say, in your investment account, you have as much time as you want. That is also true with futures. There is not a theta decay aspect, which makes the math surrounding it a little bit easier. Now, the next 2 pros are also cons. Huge leverage. This is going to be different per futures contract, but for example, one ES contract, which is the contract code for the S&P 500, that actually represents 50 shares of SPX if it were to be delivered at the end of the contract. So there's massive leverage. Like for example, oil, it actually represents 1,000 barrels of oil. A gold contract represents 100 troy ounces. When you trade a singular contract, the notional value is quite a bit. But similar to options, when you spend $1 on SPY, we understand that like $1 on a call option, that the underlying, you're representing 100 shares of SPY. That's what options represent. But that doesn't mean you have to have the money in your account to actually trade it. You don't have to have the notional value in your account to trade the full representation of the underlying, unless you plan on holding it all the way till expiration. But the way most people don't hold options all the way to expiration and they actually look to exercise it, very similar in futures. A lot of people trade futures and they never at all have intent to take the delivery of whatever the underlying thing is at the end. They're playing for the difference. In the meantime, they open, they close, and they make sure they're out of the position before the contract actually expires. But anyway, because of that, it allows you massive leverage, and then also the trading hours. Now, depending on who you are or aren't, this might be a pro, might be a con. Not all, but a lot of futures contracts actually trade on what's referred to as the Globex session. So some of them are trading 23 hours a day, excluding Saturdays. So it'll open up Sunday night at 6 p.m., trade till 5 p.m. on Monday night, take an hour off from 5 to 6, reopen at 6 p.m. again, and it's in that 23-hour cycle. I put this on pros and cons because this trading hours, you might like it. You might want to actively trade when there's maybe geopolitical turmoil in the Middle East and you want to protect your position in the middle of the night, something that maybe the options market wouldn't afford you. So that could be good. But also it might drive you nuts and you might never sleep again. Same thing with leverage. Obviously, leverage is a double-edged sword. If you're on the right side of it, massive leverage means massive gains. If you're on the wrong side of it, massive leverage means massive losses. So this is a world similar to options where leverage, if you know how to wield it, it could be beneficial. But unlike options, well, it depends, I suppose, on the options contract you're talking about. The trading hours are more similar to crypto than they are to equities. All right. So the first thing with futures is you've heard of equities before, you've heard of options, you've heard of crypto, all that good stuff. But maybe you're like, okay, like what actually is futures? Like what can I trade with it? And the first answer is actually quite a bit. There's actually quite a bit in the world of futures that you're allowed to trade. So right here on Apex, you can see you're allowed to trade the S&P 500, you're allowed to trade the Nike, you're allowed to trade the NASDAQ, the mid cap, the Russell 2000. There's futures contracts for all of these. Remember, futures are derivatives, so they're built on top of this. And these are just for the equities. There's one for interest rates, there's currencies, there's ag. Like when people are talking about sugar, coffee, corn, they're talking about futures. Live cattle, feeder cattle, you have oil, energy, you have metals. We talked about gold, silver, copper, palladium. That's an interesting one. That's actually a really expensive one to trade. And then you have micro ones. I'll come back to that because this is a more, I suppose for people with a smaller account, they have micros, which are probably something we should chat about. I'll explain what that does and doesn't mean. They even have futures on Bitcoin and Ethereum. So the higher level view of all of this is like options. I think when we Google it and we look at these definitions, it gets confusing because you're like, well, hang on, do I have to take delivery? Do I have to have a huge yard to take all this live cattle? Like, what does that actually mean? Think about it like options where you are playing for a movement in a certain amount of time and you're planning on getting in and getting out. None of us right now watching this are expecting to take delivery on S&P 500. We're not expecting to take delivery for 1,000 barrels of oil. We're not expecting to actually have 100 troy ounces like sent to us. We're looking to play the difference in gold of, is gold going up or down? Should I be long or short? The same thing with oil, same thing with the NASDAQ, same thing with the ES. So yes, there is that pure like academic theoretical definition of what it is, but most people in the market don't use it that way. Now, the people who do use it that way, the example would be something like an airline. They're like, okay, I know that my business is highly dependent on crude oil. So if I have like a long position here or a short position, they can offset business costs. If you're a massive factory farm in the Midwest, yeah, you might want some live cattle just in case your business suffers, you can hedge it. So similar to options, the futures market for the big players is meant as a massive hedge. Now, for us, we're most likely directional players of, oh, I think oil is going up, so I want to take a long position, and I want to try to ride it from 85 to 86, that type of a thing. So these are some of the similarities, and yet then some, obviously, of the differences with options. Options, yes, you have the larger equities, but then, the larger indexes, but then it's a lot of equities. While when it comes to futures, yes, you have those indexes, but then the other things are kind of these oddball, like I said, metals, cattle, blah, blah, blah. The list goes on. The next most common question is, what does it cost? How much money do I have to have in my account to possibly be able to trade futures? Similar to options, it varies. You can go buy a 30-cent SPY call, which is going to cost you $30, or you could buy some crazy at the money NVIDIA and it's going to be thousands and thousands of dollars. There is a massive, massive discrepancy depending on what you're trading. Just to show you, this is on TradeStation, but there is different rates, and this is kind of something you don't see in the world of options. There's different rates intraday than there is to swing overnight. So if you are day trading the S&P 500 in your account to get the contract, whether you want to be long or short, it is currently 1,300. And this is one of the most confusing things of futures relative to options is if the SPY goes up, if the SPY is like all of a sudden ripping out of nowhere, the same call becomes more and more expensive. Or if we're going down, a put becomes more and more expensive because it's based on the probability of the price and the where we're going to be at on the day of expiration. That's not quite how futures move. Futures, it's $1,300 to day trade, long or short. It doesn't matter if the S&P 500 goes up or go down. This is just the cost to get into the contract, and then you're still playing the difference in the underlying. And I'll give you some examples of that, and I promise you I'll make it more, I suppose, apparent, because this is one of the biggest differences that it probably sounds confusing just because other markets don't really go like this. But right now, there is a set value to go long or short the contract, and then you get in and out. And you just need to have that much money in your account to be long or short. Now, that's just for the intraday. If you plan on holding it overnight, it goes up. So usually the intraday value is about 10%. It does change if there's an FOMC meeting, all the brokerages up it, and they're like, you know what, there's no intraday value. It's just the overnight, or it's really just the maintenance margin. And so these values actually change based on volatility. So if they think the world is going hectic and things are crazy, they up it. And then if things calm down, they're like, oh, no, never mind. These contracts as a whole can actually become cheaper, much more related to the volatility of the underlying, because the brokerages want to protect themselves than anything else. And the reason they do that is they know 99.9% of people are never accepting delivery. They're just doing the trade. So they just don't want to get caught like in some like weird situation. So anyway, you could see all of these contracts, the symbol root. So ES represents the S&P 500, NQ represents the NASDAQ. So then this brings up the concept of a lot of the times of what am I talking about? What the fuck is a contract? You probably all well know it from options of like, oh, okay, no, I have these options are contracts. Like inherently, you've heard this term before, but once again, this is where it gets a little bit more funky between the world of futures and options. So in the world of futures, you have contracts that have different aspects to it. So right here, that gray part, XBT, that represents Bitcoin. ES represents the S&P 500. So that's part of the contract code, is just like the actual underlying. Then you have the next part, which is the current month that you're on. And this even gets a little bit more hairy. So I'll explain that in a second. But in this case, they're talking about M, which represents June. And then the next one is just the year. So if you were to look at what we have going on like right now in real time, if you look at ES, when you type in ES, it's just going to show you the front month, as in the one that is like currently trading. It's the active one. It's the most highly traded one. It's referred to as the front month. So on TradingView, you're just going to see E-mini, and you could get it with ES1 and it'll come up. But then to know what it's actually on, for example, you're going to see this right here. NQ, so it's June of 24. So in the very top left of your screen, or I could even show you on the S&P 500 just to keep it consistent. So it's June of 24. Now, obviously, June can have codes, as I was just showing you right. Oh, hang on. Let me bring up the right screen. Let's go back to being big. June is the M contract. And I will explain this, but there are contract roles similar to when there's an expiration date with options. There are expiration dates associated with futures, and then that would be what a roll is in this case. So you've probably heard roll before of like, oh, I'm in an options position. Should I roll it out, up, down? In the world of futures, when people are talking about a contract roll, they're talking about going from 1 month to the next month, as in the change in what the quote unquote front month is. Now, I don't want to, like, I guess, get you bogged down in too many details, but this is probably something you're going to run into very quickly. The roll period is actually different per contract. So If you look at something like the S&P 500, you'll notice that it rolls once a quarter. It rolls in June, it rolls in September, it rolls in December. So you'll trade on the same contract for 3 months at a clip. Unfortunately, whoever decided to do this, they made it very, very confusing because that's not true with all of them. If you go over to energies and you look at something like crude oil, it actually changes every single month. So this is one big thing is not all futures contracts are built the same for a myriad of reasons. And one of them is make sure you know you're trading on the right one because oil changes every single month. If you look at livestock, that's going to change at a different cadence as well. And this is weird. Check out this. Live cattle changes in April and June and August, but then feeder cattle, sometimes it's every month and then it takes a break. Like it just gets funky. So depending on the thing you're changing, obviously it's very important to know that you're on the proper front month one, the one that is like currently active. But that's part of the confusion. There's a little bit more. And this comes back to the concept of not built the same. So for me, I mainly trade ES and NQ, the S&P 500 and the NASDAQ. So I'm very familiar with them. I know they roll once a quarter, so that's not too bad. Obviously, once every 3 months, obviously every single quarter. And I know their tick size and their value and how much I need. But even that right there, what I just said, tick size, value, how much you need, that is all another example of not being built the same. So let's go through all the reasons of why all futures aren't built the same. Number one, they have different front months. So yes, you can look at the codes that I just had, and then I'll share all that documentation with you. But you just have to know and be like, oh, did it roll this month, or are we looking at next quarter? So depending on what you're trading in futures, different from month. So you have to be on the right contract. Another thing is the hours. So as I referred to, yes, most of these are going to be on a 23-hour, like just Globex session is what it's going to be referred to, 23 hours a day. But that's not everything. You're going to have weird things that take a break sometimes midday. So it's not like all of these. Like right here, live cattle trades from 8:30 to 1:05 Central Time. While if you look at ES, that's going to trade at a much larger window. So even though they're all futures, they do have different trading times. So you have different contract rollovers. You have different time. And this is where it's going to get really, really wild. But I promise you, as confusing as this sounds, I promise you, if you start trading futures on a sim account, like no money, paper trading, buying, selling, just kind of going crazy with it, you will learn it more rapidly than you possibly can. So don't have any money on the line. Just get on a sim account, buy and sell, and it'll very quickly make sense. And I know all of this sounds a little bit jarring just because there's not other markets like the futures market. Yes, there's some similarities with options, but it's not perfect similarities, and that's where all these differences really, truly arise. So let's get into the major differences. Some of the major differences are actually tick size. So let me just show you right here. So ES, if I bring up a minute chart, you're going to notice that it trades in 0.25 increments. So it goes from 0.00 to 0.25 to 0.5 to 0.75 to the next whole number. Each one it moves, these are referred to tick and tick size. So each tick is sized at 0.25, and each tick is financially worth $12.50. So in one full point, which is obviously 4 ticks, you're actually talking about not a movement of $1, but a movement of $50. Now, that's for ES, the S&P 500. And even another index is different. So this one has the same min tick size of 0.25. It's going to go from 174 to 174.25 to 174.5. So like if I really zoom in here, you're going to see that the tick size is by 0.25. But for the NASDAQ, they're not worth $12.50 each, which makes the whole point $50. These are actually worth $5 each. So that means the whole point is actually worth $20. And obviously the differences keep going and going and going. So for example, if you look at crude oil moves in hundreds. So it'll go from 85.45 to 85.46 to 85.47. And so not only is that a different min tick size, before we had 0.25, this one has a min tick size of 0.01. So it's a different min tick size. On top of that, each one is actually now worth different. So if you move a full dollar in oil from 85 to 86, that's actually $1,000, which means every single min tick size movement is $10. So this is just another one of, I'm trying to tell you that not all futures are built the same. you have different contract rollover rules, you have different trading hours, you have different tick size, and you have different tick size value. So here just shows you some of these, but obviously it goes on and on and on. Now, if you're curious, you're like, dude, how do I get all this information? That's a lot. Like, what do you mean? Do I just memorize it? What's going on? There's a lot of free resources out there, like barchart.com. You can click around and see. So right here, I was telling you the S&P 500, it moves in quarter points. 1 full point is worth $50. And then obviously I was using oil as an example. So right here, oil, it trades in 1 cent increments, which means a full dollar, aka a point, is actually worth 1,000. And then you could just keep checking it out. So here you can get the size, you can get the trading hours. And once again, this is free. So it's not like you're going to have to pay for this type of information, but you could see, like, for example, livestock trades in even smaller increments, 0.00025, and each one's worth $400 if you go a full point. So $10 per contract. So that might all, you're like, well, hang on, how do I know if I'm getting into a situation that's way too big, way too small? And that's exactly what I'm telling you. The fastest way you could learn any of this is literally getting on a sim account and just hitting buy and sell. There's a lot of things like NinjaTrader that allow you to do that. Get a sim account, just buy 10, sell 10, see what's going on. That's going to be the fastest way for you to wrap your head around.